Your house is one of the biggest purchases you'll make in your entire life, and one mistake can cost you everything. If you're looking to sell your home, you need to make sure you know what you're doing so you don't end up paying hundreds of thousands of dollars in taxes, because guess what? It could have been completely avoided. Now, before we continue, if you're earning $300,000 or more and can't believe how much you're paying in taxes each year, right now is the time to take action to get your tax bill under control. Reserve Tax Advisors specialize in lowering your tax bill to the fullest extent through our advanced strategic tax planning and entity structure optimization while protecting your assets and minimizing your exposure. Our clients have saved anywhere from $20,000 to $150,000 in taxes, and you can do the same to keep your money where it actually belongs. Schedule a free consultation to see how we can work with you to get your taxes down while increasing your wealth. The link will be in the description. Now back to the video. When you sell your home, you need to plan and time the sale correctly to take advantage of what's called the Section 121 when it comes to selling your home. There's also a few things that you need to know so you don't get surprised with an unexpected tax bill that no one else talks about. So stay with me on this one, since it can make the difference between you coming out of the sale with your pockets full or having to pay the IRS when you didn't have to in the first place. Send it to your friends, your family, send it to anyone you know who is looking to sell their home so you can help them save hundreds of thousands of dollars in taxes and be the hero for them. Let's get right into it. Your home is one of the biggest purchases you'll ever make, so when it comes time to selling it, you're working with big numbers. Now, normally, big taxes follow big numbers, but you can kick the taxes out the door if you do this correctly. So listen close. If you've lived in your house for a good amount of time, there's a chance that it has gone up in value. This is called appreciation, which will normally increase the gain on the sale, which will then increase the taxes that you'll owe. But it's a good thing you're watching this video right now, because I'll show you exactly how you can plan for the sale to potentially bring your taxes down to zero so you can keep all the money in your pocket. The IRS has created Section 121, which will let you exclude a certain amount of gain if you meet some requirements. This is why it's important to plan and time the sale to qualify for the Section 121 exclusion. Now, for the sake of this video, when I say home, we're talking about your primary residence, not a rental property, not an investment property. A sale of a rental or investment property is treated differently and will be for another video. For the sale of your primary residence, here's how to plan for the sale to get the best possible outcome. The first thing you need to do is you need to check that you meet the ownership and use test that determines if you're eligible for the Section 121 exclusion. For the ownership test, did you or your spouse own the home for at least 2 out of the last 5 years? For the use test, did you and your spouse own the home and use it as a primary residence for at least 2 of the previous 5 years? If your answer to both tests are yes, I got good news for you. You may be eligible to exclude up to $500,000 of gain on the sale of the home. Yes, you heard that right. I said $500,000. This is a huge amount that you get to exclude completely and keep the entire proceeds from the sale without giving a cent to the IRS. The gain exclusion limitation is based on your filing status. So if you're filing single, you can exclude up to $250,000, while taxpayers filing as married filing joint can exclude up to $500,000. Now here's how you can plan for the sale and time it correctly to ensure you get to exclude the maximum amount. You'll be able to get the highest exclusion amount if you're filing as married filing joint. If you're not married but are engaged, make sure to get married before considering selling your primary residence to be eligible for the $500,000 exclusion instead of the lower $250,000 exclusion. Don't force a marriage for the higher exclusion for obvious reasons, but if you're already engaged, considering getting married before selling the property will be an important consideration to think about, just for the higher exclusion amount that you would be able to take. Make sure you time the sale so you meet the requirements of the Section 121 exclusion, as it can be the difference between you owing nothing or you owing hundreds of thousands of dollars. For the ownership test, either you or your spouse must meet the test, which gives some flexibility in being able to meet it since it requires just one of you to meet it. However, for the use test, both you and your spouse must meet the use test individually. Now, this means that either you or your spouse must have owned the home for at least 2 years out of the last 5 years, and you both must have used it as your primary residence for 2 years out of the last 5 years. The duration for both tests does not need to be consecutive, but it must exceed the 2-year threshold within the last 5 years. In the case where you determine that the gain on the sale will exceed even the higher $500,000 exclusion limit, Plan for the sale to be in a year where your taxable income is lower to pay the least amount of tax as possible. If you have income from other sources, you'll be in a higher tax bracket, which will result in higher taxes. But if you sell the home in a year where the amount of income from other sources are minimal, you'll be in a lower tax bracket, which will result in lower taxes. Planning and timing the sale based on these 3 points will make sure you pay the least amount of taxes as possible on the sale of your primary residence. Now, I also mentioned earlier on in the video that we'll be talking about something that no one else talks about that is extremely important. Now, listen close because you don't want to get an unexpected tax bill that you're not prepared for. There are some cases where you may still owe taxes even if you were able to fully exclude the gain on the sale. Let's talk about the different scenarios when this might happen. One scenario is if you have a business and you've taken home office deductions, including depreciation. You will owe a certain amount of taxes. When you sell the home, you'll have depreciation recapture on the depreciation that you've taken because depreciation is a tax deferment. It's not a tax deduction. What this means is that the amount of depreciation that you've taken in the past will be taxable at ordinary income rates, which can be up to 25%. This will apply even if the Section 121 exclusion fully excluded the gain on the sale of the home. If you've ever rented a part of your home or rented a room of the home where you took depreciation for the rental activities, you will recapture that depreciation as well, and it will be taxable at ordinary income rates, which can be up to 25%. Same principle as the home office, but for your partial rentals of your home. If either cases apply to you, be sure to keep some of the money on the side, since it's always better to expect the bill and prepare for it rather than having an unexpected bill staring at you. Buying and selling your home is going to be one of the biggest transactions you'll make in your entire life, so it's especially important to get it right so you don't pay taxes when you weren't required to in the first place. If this video has helped you out, please leave a like and subscribe for more videos just like this. Leave a comment for any questions you have and I'll be sure to get back to you. Thanks for watching. I hope you got the information that you were looking for and I will see you on the next one.